Hello everyone and welcome back. The start of 2022 has not been great for equity markets as well as crypto in general. So what's going on? This video is going to take a bit of an in-depth dive and look at the economics and macroeconomic effects at play on the wider equity markets to try and help give you guys some understanding as to how this is going to play out and what you should be thinking about doing over the long term. So if you looked at any of the headlines today, Dow and the S&P, some of the largest markets and funds within the United States and globally, as a matter of fact, have fallen quite sharply from their all-time highs. If we come over to CoinMarketCap and look at the cryptocurrency markets in general, it's a similar story playing out with a lot of them bleeding across the board. A lot of this is as a reaction to macroeconomic policy changes within the United States. If we look at the fear and greed index for the US markets, we can see that we're in neutral and we're heading towards the extreme fear. And in the crypto markets in general, we are in extreme fear. And this signifies the loss of market cap that we're seeing across the board in these markets. So what's happening? Early this month in January, the Fed released their meeting minutes from their earlier meeting of December 2021. So what's happening? Okay, so the Federal Reserve have basically said that they're going to be increasing interest rates. And what we're seeing playing out is the US Treasury yields for at 10-year constant maturity are beginning to increase. So we can see here they had a sharp fall throughout 2020 as Rona struck. Heading through 2021, they've started to pick back up as we've come out the other side effectively of the pandemic that struck the globe. What we're starting to see though is the rate of change of these interest rates is a lot more dramatic than what was first thought. Now, US Treasury or bond rates and interest rates are effectively within financial circles deemed the risk-free rate in terms of financial equity valuation. Now, what does this mean? Well, effectively, you can put your money into a savings account or a bond and it's completely risk-free because it's backed by the government. You are taking no inherent risk to hold that asset. It's a guaranteed return. As these guaranteed returns increase, your appetite to take additional risk to receive additional return drops off naturally. It's an opportunity cost. Why take excessive risk if you can get risk-free returns? Okay, so what's been happening? Over the course of 2021 and actually 2020 as the pandemic hit, something called the M1 money supply had a massive shock, and effectively the Fed and the government through fiscal policy, but mainly through monetary policy, were effectively injecting liquidity, cash, dollars into the economy. This M1 money supply is a measure of how much money is circulating within the economy freely, the amount of dollars and notes and coins within circulation. This increased money supply leads to increased liquidity. Not only that, because of the increased liquidity, there are lower interest rates. If you think about it, every bank, every company has got additional cash they have sitting there, effectively gathering dust and not earning them a penny. So interest rates fall as banks and companies effectively fight to park their money somewhere for yield. Not only that, as we see increasing money supply, as there's more liquidity sloshing about within an economy, inflation begins to spike dramatically, which is what we're currently seeing, and this is why the Fed is responding in the way they are, is there are fears that inflation will take hold. And if you cast your minds back, if you know a little bit about history, where we've seen hyperinflation in post-war economies such as Germany, for example, you get to a stage where the currency devalues at a rapid rate and it's effectively exponential. So something that starts off as being a non-existent problem quite quickly becomes a massive problem. Okay, so that's a quick history lesson of what's happened over the last couple of years. So what's happening now? Well, the Fed has recently come out and said that they are going to begin tapering their monetary policy. So for us to understand this, first we need to understand how the Fed actually provides stimulus. So as we said before, they inject money into the economy. This is measured through the M1 money supply, but how do they actually inject this money into the economy? Well, it's done by a means of quantitative easing. This isn't in the sense of they directly print money. They increase the money supply by buying up bonds from the market, thereby injecting those dollars into the economy that can be exchanged and deployed at will of whoever sold the bond to the government or the Fed. So the Fed's response to increasing inflation and wanting them to contract their money supply and perform contractionary monetary policy, the Fed will now begin to slow down their purchasing of assets and bonds. This slows down the new money entering the market. Now, in terms of us thinking about equity markets in general, realistically, efficient market hypothesis would suggest that this tapering increasing of interest rates should have already been priced into equity, just by the nature that we knew that small or non-existent interest rates are not indefinitely sustainable within an economy. However, the rate at which they have been purchasing assets is more than we had ever experienced as an economy. So what's happening? Well, inflation is at higher levels than we expected, and the rate of taper is much larger than anticipated by investors. Not only that, there's a third dimension at play here. Along with their contractionary monetary policy, where they slow down purchasing of bonds, the Fed has also turned around and mentioned their swollen balance sheet, which is currently sitting at somewhere around $6.5 trillion on their balance sheet. This was pointed out in their most recent meeting in December of 2021. Now, they've stated they are going to begin to reduce this balance sheet. As we can see here on this graph, their balance sheet has grown exponentially, effectively, over the course of the last sort of 20 years, and it's sitting at effectively all-time highs. So they need to effectively contract this balance sheet. Well, how do they do this? So if they put money into the market, they buy bonds. If they want to reduce their balance sheet, they sell bonds to the market. This decreases the aforementioned M1 money supply because it takes money out of the market. People effectively give the Fed money to purchase these bonds. What we see here is effectively a supply shock. Supply moves across, demand stays consistent. The asset price, or bonds in this case, reduce as the quantity on the market increases. At the same time, there's an inverse relationship between the price of a bond and the interest rate. So as the price of the bonds falls, the interest rate rises. And in this case, interest rates are effectively a proxy for a risk-free rate, and they're directly correlated to equity markets. So these balance sheet sell-offs that the Fed are going to be doing will further increase interest rates over the period. So now we understand that there are further interest rate hikes coming, but it's the fact that they're at an undetermined rate, and it's this rate of change is what scares equity markets. It can't be priced in effectively, and it's unknown as to what the next moves are going to be from the Fed. Okay, so what do? Well, effectively, we sit back and we look at the long term. This is going to be a minor macroeconomic shock to the equity markets, as well as cryptocurrency markets, in fact, any market in general. If we take a look at the 5-year chart, for the S&P 500, we can see we're up over 4% over a 5-year period. And these blips, like here, the pandemic sell-off, effectively become blips on the market. They may last three months, they may last a year. Over the long term, these become small peaks and valleys. Same thing could be said about the Bitcoin pricing over the last 5 years. Gradual increase, and it's not plain sailing the entire way. Not only that, we take a look at the crypto market capitalization and volume, and that's been gradually increasing over a 5-year period. So it's not time to panic. It's time to sit back, chill out, get some fresh air, and we move forward. Cheers for watching.